The most dangerous sentence in investing is not, "The market will crash tomorrow." It is, "The market can never go down again." That sentence always sounds ridiculous when you say it plainly. Every investor knows markets fall. Every chart proves it. Every generation has lived through recessions, panics, bear markets, banking scares, inflation shocks, wars, bubbles, and crashes. And yet, near the end of every powerful advance, people begin believing some version of that sentence. Not always in those words. They say liquidity will always return. They say the government cannot allow markets to fall. They say debt is so large that money printing is inevitable. They say inflation will push all assets higher forever. They say artificial intelligence has changed the rules. They say the old valuation measures no longer matter. They say every dip is bought immediately. So risk has disappeared. They say cash is trash. They say owning stocks is the only rational choice because the currency is being debased. Some of that contains truth. That is what makes it dangerous. The worst investment ideas are rarely 100% false. If they were, fewer people would believe them. The worst ideas are directionally right and mechanically wrong. They capture a real force, then turn it into a reckless conclusion. Yes, the United States has an enormous debt problem. Yes, governments with too much debt have an incentive to let inflation do part of the work. Yes, cash loses purchasing power over long periods. Yes, productive assets usually beat idle money over time. Yes, stocks can rise in nominal terms when the currency weakens. Yes, artificial intelligence may create real economic value, but none of that means the market cannot crash. None of that means valuations do not matter. None of that means leverage is safe. None of that means every asset rises equally. None of that means you can buy anything at any price and be rescued by money printing. That is the difference between understanding the direction of history and confusing yourself into stupidity. The viral idea that stocks only go up is just the newest version of an old temptation. It is the belief that because the government owes nearly $40 trillion, because deficits are massive, because money supply tends to grow, and because the dollar loses value over time, stock prices must rise forever and can no longer fall in any meaningful way. It sounds clever. It feels rebellious. It lets a person believe that risk management is old-fashioned, but it is wrong in the way that ruins people. The truth is more subtle. In a debt-heavy world, the government is strongly incentivized to reduce the real value of its obligations. One way to do that is through financial repression, keeping interest rates below inflation long enough that the debt becomes easier to manage in real terms. The nominal debt may still rise, but if the economy and prices rise faster, the burden can shrink relative to national income. This is not fantasy. The United States used a version of this after World War II. Debt was high. Rates were controlled. Inflation ran above yields. The debt burden fell over time, not because the government behaved like a household and paid everything down through discipline, but because the value of money changed and the economy grew. That is the real lesson. Governments do not always default honestly. Sometimes they default politely through purchasing power. They pay you back with dollars that buy less. For the saver, that is painful for the government. It is useful for owners of certain assets. It can be beneficial for people with fixed rate debt. It can be helpful for people holding cash for decades. It is destructive. So the melt-up theory begins with something real. If the currency is being debased, nominal asset prices may rise. A stock index can reach new highs partly because the measuring stick is shrinking. A house may cost more dollars. A business may report more nominal revenue. A commodity may trade higher. Gold may rise. The market may look strong while the dollar is quietly weakening. But here is where the theory breaks. Nominal price is not the same as real wealth. If your portfolio doubles, while the cost of life also doubles, you did not become twice as rich. You merely kept score in a weaker unit. If stocks rise 8% while your true cost of living rises 7% and taxes take part of the return, the statement may look healthy while your purchasing power barely improves. This is why inflationary periods are so confusing. People see higher numbers and assume they are winning. Then they go to the store, the insurance office, the mechanic, the doctor, and the tax collector, and discover the victory was smaller than it looked. The market can go up in dollars and still disappoint in purchasing power. That is the first lesson. The second lesson is that even if stocks trend higher over long periods, they can fall violently along the way. A long-term upward path does not protect you from a 30, 40, or 50% drawdown. It does not protect you from being forced to sell. It does not protect you from panic. It does not protect you from buying at a valuation that takes a decade to justify. The market can rise over decades and still ruin the impatient. Those two things are both true. The SP 500 can be a wonderful long-term vehicle and a terrible short-term place for money. You need next year. Stocks can beat cash over 30 years and still do nothing for 10. A great business can compound for generations and still be overpriced today. A government can inflate the currency and the market can still crash before recovering. That is why intelligent investing requires more than a slogan. Now let us talk about the great melt-up. A melt-up is the final euphoric phase of a bull market. Prices stop being driven primarily by earnings, cash flow, or reasonable estimates of value. They are driven by momentum, fear of missing out, and the belief that everyone else is getting rich faster than you are. At first, the rise is supported by fundamentals, then it is supported by liquidity, then it is supported by psychology. Finally, it is supported by nothing but the need for the next buyer to pay a higher price. That last stage can be spectacular. The final year of a bubble often produces some of the largest gains. That is what seduces people. They watch friends become wealthy. They watch stocks recover from every dip. They watch headlines celebrate new highs. They watch analysts raise price targets. They watch skeptical people look foolish for months or even years. Then the conclusion forms. Maybe risk is gone. Maybe this time really is different. Maybe the government has removed the downside. Maybe money printing makes stocks mathematically unable to fall. That is when the danger is highest. History is full of melt-ups. The late 1990s technology boom is the obvious example. The internet was real. It changed business, communication, commerce, media, and the entire economy. But in 1999, the reality of the internet was mixed with extreme valuations, speculation, margin debt, and the belief that old rules had been repealed. The NASDAQ rose dramatically and then fell roughly 78% over the following years. The internet won. Many investors lost. Japan. In the late 1980s, as another warning, stocks and real estate rose to extraordinary levels. People believed Japan had discovered a superior economic model. Land under the imperial palace was famously estimated at absurd values. Then rates rose, the bubble broke, and the Japanese market took decades to recover. The country did not disappear. The investors who paid the highest prices suffered for a generation. That is how bubbles work. They do not always end because the underlying idea was false. They end when price, leverage, expectation, and liquidity stretch beyond what reality can support. Now look at today. The market has been hitting record highs. Money supply has grown over time. Debt is enormous. AI gives investors a powerful story. Wall Street firms raise targets. The idea of a melt-up feels plausible because the pieces seem to fit, but valuations matter. When investors pay far more for earnings than they historically have, future returns become more fragile. The CAPE ratio, which smooths earnings over time, has only reached extreme levels a few times in history. Those moments did not guarantee an immediate crash, but they did suggest that buyers were accepting lower future returns and higher risk. A high valuation is not a timing tool. It is a warning about expectations. A market can remain expensive for a long time. It can become more expensive. But the higher the starting valuation, the more perfect the future must be. If earnings disappoint, rates rise, inflation changes, liquidity tightens, or enthusiasm fades, the downside becomes larger. This is why the idea that stocks cannot fall because debt is large is so dangerous. High debt can push policymakers toward inflation, but high debt can also create instability. If investors demand higher yields to hold government bonds, rates can rise. If rates rise, stock valuations can compress. If inflation rises faster than expected, the Federal Reserve may not be able to cut. If the currency weakens too quickly, confidence can fall. If confidence falls, assets can sell off, even in nominal terms. Debt is not a magic levitation device. Debt is pressure. Sometimes pressure pushes money into assets. Sometimes pressure breaks the pipes. Now, the melt-up argument often says the government must print money to pay the interest. That is not exactly how the system works. The government borrows by issuing treasuries. Those treasuries are bought by individuals, institutions, pension funds, banks, foreign governments, money market funds, and many others. The Federal Reserve can buy treasuries under certain policies, but the system does not reduce to one man pressing a button every morning to pay the interest bill. That does not make the debt harmless. It means the mechanism matters. The danger is not that the government literally has no way to pay tomorrow. The danger is that the more it borrows, the more interest it owes. The more interest it owes, the more debt it may need to issue at some point. The cost of maintaining confidence rises. If buyers demand more yield, the math worsens. If the central bank suppresses yields, inflation risk rises. If taxes rise, growth may slow. If spending is cut, voters rebel. There is no painless option. That is why financial repression is so tempting. It spreads the pain slowly. It does not require a dramatic default. It does not require immediate austerity. It does not require a politician to say, we failed. It simply keeps real returns low, lets prices rise, and allows debt to be paid back in cheaper dollars. But the cost does not vanish. Savers pay, workers pay, retirees on fixed income pay, people holding too much cash pay, people whose wages lag their living costs pay. That is the hidden tax. Now, does that mean stocks automatically protect you? Not always. Stocks are ownership claims on businesses. Good businesses can raise prices, earn profits, adapt to inflation, and compound capital over time. That makes stocks one of the best long-term defenses against currency debasement, but the protection depends on what you own, what price you pay, how long you can hold, and whether you are forced to sell during bad periods. Germany, Zimbabwe, Venezuela, and even the United States in the 1970s show the same lesson. Nominal returns can look impressive while real purchasing power suffers. A market can rise in local currency terms and still leave ordinary people poorer. You do not live in nominal returns, you live in purchasing power. Every asset has a season. Gold is insurance, not a religion. People buy it when they worry about inflation, currency weakness, crisis, and distrust in financial systems. It can be useful, it can preserve value when confidence falls. Central banks may buy it, investors may use it as a hedge, but gold does not produce cash flow, it does not build a factory, it does not invent a product, it does not hire workers, it does not compound earnings. It sits there. That can be exactly what you want in a crisis, but it is not the same as owning a productive business. Gold can outperform during fear and underperform when fear fades after the 2008 crisis. Gold rose during the era of stimulus and inflation concern, then fell and stayed weak for years as confidence returned. After 2020, it rose again as money printing, inflation, and debt fears returned. So gold has a role for some investors. But putting an entire financial life into one hedge because you are afraid is not investing. It is panic with a shiny color. Bitcoin, commodities, real estate, stocks, bonds, cash, and gold all have different roles, different risks, and different environments where they work. The intelligent investor does not ask, what one thing saves me from everything? That thing does not exist. The intelligent investor asks, what combination of assets gives me resilience across several possible futures? That is the proper question. Now, what is the most realistic path forward? Not sudden hyperinflation, not a market that can never fall, not a clean return to fiscal discipline. The most realistic path is a long period of financial repression and uneven inflation. Inflation runs somewhat higher than people remember. Rates may drift lower, but not enough to give savers a true real return. Asset prices rise in nominal terms. Taxes creep higher. Markets experience periodic scares, drawdowns, and recoveries. Life gets more expensive slowly. Cash loses value slowly. Asset owners look richer slowly. Savers feel squeezed slowly. That is not dramatic enough for social media, but it is more likely than the fantasy of stocks rising forever without pain. In that world, stocks can make new highs over time and still fall 30, 40, or 50% along the way. That is why time horizon matters. The same asset can be prudent for one person and reckless for another. Now let us talk about leverage. The melt-up idea becomes most dangerous when people use it to justify borrowing. If stocks cannot fall, then margin seems logical. If every dip is bought, options seem logical. If the government must print, concentration seems logical. If cash is trash, keeping no cash seems logical. That is how people get destroyed. Leverage does not care that your long-term thesis is right. It cares about the path. If the market falls far enough before your thesis plays out, you can be forced to sell. A margin call does not ask whether the United States has too much debt. It does not ask whether AI will change the world. It does not ask whether the market will eventually recover. It asks for cash if you do not have it. It sells your assets. That is why the people who survive inflationary and volatile periods are not always the boldest. They are often the ones with steady income, diversified assets, manageable debt, and enough cash to avoid forced selling. That sounds boring. Boring is underrated. Boring survives. The person who stays solvent gets to buy when others are forced to sell. The person with cash during a panic can act. The person with no leverage can wait. The person with a plan can ignore viral theories. The person who understands what he owns does not need to ask strangers whether to panic. That is real advantage. Now, what does always be buying really mean? It does not mean always be reckless. It does not mean buy every dip blindly. It does not mean spend your emergency fund because a stock is down 5%. It means build a system where you consistently convert earned income into ownership over time, while also preserving enough liquidity to take advantage of panic. It means you buy during good markets, sideways markets, and bad markets, but you do it with discipline. You keep a watch list. You know what you want to own. You know what price makes sense. You know your risk, your time horizon. Always be buying is not a slogan for gamblers. It is a habit for owners. Owners understand that downturns create opportunity. In 2020, stocks fell sharply and later recovered. In 2022, many stocks declined meaningfully and created opportunities. In 2008, high-quality assets were available at prices that later looked absurd. In 2000, many internet stocks were destroyed, but the companies that survived or were bought later became the foundation of the next era. Panic creates overselling. Overselling creates opportunity. Opportunity creates profit for the prepared, but only for the prepared if you have no cash, no research, no emotional discipline. And too much leverage. A crash is not an opportunity. It is a personal emergency. You cannot buy bargains when you are the bargain. That is why preparation matters before the decline. You cannot build a fire extinguisher after the kitchen is burning. Now let us talk about Buffett's cash. People love to point at a large cash pile and declare that Buffett is predicting a crash. That is too simple. Cash is optionality. It is insurance. It is the ability to act when others cannot. It is the discipline to refuse prices that do not make sense. Cash has a cost because inflation erodes it, but having no cash has a different cost. It removes your ability to take advantage of disorder. Cash is not a long-term wealth engine. Cash is a shock absorber, and shock absorbers matter when the road is rough. Now, what about the national debt? A debt to GDP ratio above 100% is serious, but it is not automatically the end of a country. The United States had a very high debt burden after World War II and reduced it over decades through growth, inflation, controlled rates, and policy choices. That does not mean today will be easy. The demographics are different, politics are different, global competition is different. The dollar's reserve status is challenged more openly. Entitlement obligations are larger. The trust in institutions is weaker, but history says debt problems usually evolve slowly before they become sudden. That gives investors time to prepare. It does not give them permission to panic. Ray Dalio's long-term debt cycle framework is useful here. Great powers rise, borrow productively, become wealthy, overextend, print more, experience internal conflict, face external competition, and eventually see their currency dominance challenged. That cycle does not play out overnight. Reserve currencies do not vanish on a Tuesday because someone posted a chart. They erode as trust, productivity, discipline, and alternatives change. The dollar may remain dominant for a long time. It may also gradually lose purchasing power and relative trust. Both can be true. The proper response is not to abandon all dollars tomorrow. You still need dollars to live, pay taxes, buy food service debt, and handle emergencies. The proper response is to avoid having your entire future depend on dollars holding their value perfectly. Own productive assets. Own some hedges if appropriate, build skills, avoid bad debt, keep liquidity, stay flexible. That is better than panic. Now, what should an investor actually do in a possible melt-up and financial repression environment? Keep investing steadily in productive assets, but do not confuse steady investing with chasing extreme valuations in one hot theme. Diversify, keep enough cash for safety and opportunity. Avoid leverage unless you can survive being wrong. Measure returns in purchasing power, not just dollars. Do not build your plan on bailouts. And remember that downturns are normal. A market that falls is not broken. A portfolio that cannot survive a fall is broken. Now let me address the emotional side when the market rises every day. Caution feels foolish. People who warn about valuation look old. People who keep cash look slow. People who diversify look timid. People using leverage look brilliant. People buying the hottest names look like geniuses. Then the market turns. Suddenly the boring people look prepared, the cash looks useful, the diversification looks intelligent, The lack of leverage looks like wisdom. The hot trades become confessions. This cycle repeats because human nature does not change. Technology changes, policy changes, money supply changes, but fear and greed remain the same. The crowd still extrapolates. The crowd still buys late. The crowd still sells low. The crowd still believes the current story repeals history. It does not. History does not repeat exactly, but human behavior rhymes beautifully. Now, the final test: if the market keeps rising for another year, will you become reckless? If your neighbor gets rich in AI stocks, will you abandon your plan? If a viral post says stocks can never fall, will you believe it because it feels good? If inflation slowly erodes cash, will you intelligently own assets or panic into speculation? If the market falls 40%, will you have cash and courage or margin debt and fear? If gold rises, will you understand it as insurance rather than a magic wealth machine? If stocks go nowhere in real terms for years, will you remain patient enough to keep buying good assets? If the government represses rates and inflates debt away, will your portfolio survive the hidden tax? That is the test. The world is not ending every time people are anxious, and the market is not risk-free every time people are euphoric. Debt matters, inflation matters, money printing matters, AI matters, geopolitics matters, but none of them repeal arithmetic. A good asset bought at a foolish price can disappoint. A volatile market can fall. Even in a long-term inflationary trend, a currency can weaken while investors still lose money. A hedge can protect you in one environment and hurt you in another. A crash can be painful for the unprepared and profitable for the disciplined. So do not panic. Do not worship the melt. Up, do not bet your life on a viral theory. Do not sit entirely in cash because you are afraid. Do not use leverage because you think the government removed risk. Build income, buy ownership, keep liquidity. Diversify, study history, measure wealth and purchasing power. And remember this: markets go up over time because productive assets create value and currencies lose purchasing power. Markets go down along the way because human beings overpay, overborrow, overbelieve, and then panic. Both truths matter. The investor who understands only the first becomes reckless. The investor who understands only the second becomes paralyzed. The investor who understands both becomes dangerous in the best possible way. He keeps buying, he keeps cash, he avoids leverage, he waits for opportunity. And when everyone else discovers that stocks can still go down, he is ready.